I'm Pilar Marrero, Associate Editor for American Community Media. And today we will be looking beyond April 15th, how taxation is changing. As this year's tax season draws to a close, the Internal Revenue Service, IRS, is undergoing a dramatic transformation. The agency is expected to slash thousands of jobs, reducing its workforce by 18% by late May, as planned by billionaire Elon Musk under the banner of the Department of Government Efficiency, DOGE. While the stated goal is to cut costs, experts warn that these staffing reductions could reduce government revenue by as much as $395 billion over the next decade. At the same time, the Republican-controlled Congress is pushing to extend the 2017 Trump-era tax cuts. Analysts estimate the extension would add $4 trillion to the national debt over 10 years, with the majority of the benefits flowing to the wealthiest Americans. A panel of leading experts will explore the far-reaching implications of these changes on government revenue, the economy, and taxpayers across the country. Our guests today are Natasha Sarin, Professor of Law and Finance at Yale University and President of the Budget Lab; Michael Kircher, Deputy Director of the NYU Tax Law Center; Richard Priscinzano, Director of Policy Analysis at the Budget Lab; and Aravind Bodupalli, Senior Research Associate at the Urban Brookings Tax Policy Center. We are honored to have you all here today. Reporters, please enter your questions in the chat, and we will answer them as time allows. So we begin with Natasha Sarin. We are honored to have you. The organization you lead has been doing great analysis of the impact of the administration's moves on the IRS and taxation, among other issues. Please go ahead and take the stage. We are eager to learn what you found.
Great. Well, thank you so much for having me. And luckily, we also have Rich with us, who is the real expert on all areas of the Budget Lab's analysis. What I want to do is sort of do a little bit of big picture about my understanding about what the administration has in progress with respect to the IRS and why I think it matters. And I'm kind of uniquely well positioned, I suspect, to be commenting on this because for the first 2 years of the Biden administration, I worked at the Treasury Department. And in my time at the Treasury Department, I was working primarily on issues of tax administration. And so I've been very close to making the argument for why the IRS needs greater funding and needs to be able to modernize. And I'm now very close to, and part of what Budget Lab is doing is trying to understand as we roll back some of those efforts, what the consequences are likely to be. Some of the big picture statistics I think are pretty important. And so maybe I'll start with a few of those. Next Tuesday, not exactly next Tuesday, because people will file for extensions, but over the course of this tax filing season, the IRS is going to collect about 97% of the revenues that fund the federal government. That should be around $5 trillion this year. Of that $5 trillion that they're going to collect, they're going to miss out on a fair bit of revenue. They're going to miss out on about $700 billion in taxes that are owed to the IRS and won't be collected. And the reason they won't be collected is because the vast majority of all of you are wage and salary earners. Your taxes are withheld automatically. And so there's not really much for you to do vis-a-vis you still have to file your taxes, you have to pay, but there's not really much for you to do vis-a-vis opportunities to evade or underpay your tax obligations. But for certain types of people who happen to accrue income in different ways that are less visible to the IRS, there's a lot of scope to manipulate and pay less than true tax liability. And just because of the way the economy works, and maybe this has something to do with the nature of the tax rules, but maybe it has something to do with the different kinds of occupations that people are in, and it certainly has something to do with the fact that disproportionately the people at the very top of the distribution are responsible for the largest share of taxes that are owed. The vast majority, not the vast plurality of underpayment is coming from the very top of the distribution. So we have some work that we've done, and it confirms work that I did when I was at the Treasury Department, where we tried to say how much of this non-compliance of this $700 billion is coming from the top. It turns out that about 30% or something like $200 billion is coming from 250 is coming from the very top of the distribution, the top 1%. Interestingly, the IRS's scope to be able to do that type of enforcement at the top of the distribution is what it has historically been lacking most. And that like kind of makes some sense. That type of work is hard. So it requires a lot of manpower. It requires like literal people reading thousands of pages of corporate tax returns and trying to learn something about partnership law and figure out how to apply it. And all of that is takes both expertise and also a lot of time and resources from the agency to be able to do well. As a result of the passage of the Inflation Reduction Act in the Biden administration, there was this like big investment in giving the IRS the scope to do more of this type of work. And was going to raise a lot of revenue because there's a lot of uncollected taxes currently. So it was like an effort, and it was also going to help the IRS modernize. Today in meaningful ways. They're still doing a lot manually. So they're in situations where individuals are literally hand transcribing line items, circling with a red pen, typing on the type, like on the not typewriter, but typing on their computers, particular line items from particular pieces of tax returns. And the goal was to modernize those efforts, to be able to answer more phone calls, and to be able to do more compliance oriented towards these high net worth people, where like an extra hour spent by the IRS on this work was generating like $4,500 in taxes that otherwise weren't being collected. So like that was the focus of the efforts. Why that focus is relevant is because that's the first thing that's been unwound by this administration's pushes to decrease the size of the agency and decrease the investments in the agency. So the literal first thing that has happened, and has happened already, is that the IRS has gotten rid of 7,000 probationary employees. Those probationary employees are people who either were recently hired to the IRS or who were recently, they were promoted to different roles within the agency. And so you can think of them as disproportionately the people the IRS had managed to bring on, to convince to join the agency to do this type of difficult high-end work. It's not exclusively who they are, but like it's a good way of understanding like basically the first people out of the agency were the first people that were hired who were disproportionately working on those areas of great need with respect to tax compliance. We have at the Budget Lab have tried to estimate how much revenue you are going to lose if this sort of is the tip of the iceberg with respect to what the administration has said you're going to do with respect to the IRS. And they envision a much more significantly scaled back IRS. And we've heard reports, Pilar gave some, but we've heard numbers ranging from they're going to cut the agency by 15% to 25% to 50%. When we did our estimation, we used like and Rich can talk about what he speculates the differences are going to be depending on where the IRS ultimately lands from a size perspective. We did an exercise where we took the far end of those estimates. So we said, let's say that the IRS of the future is 50% smaller than the IRS today. First of all, that's like a hugely significant shift. That would be like the IRS at levels it hasn't seen since 1960, at a time when the population was like 60 million people smaller and the economy was much less complicated. So it would be like kind of cataclysmic. But we try to say like what would happen if if you shrunk the IRS by that amount. And what we conclude is that there's a pretty big range. So our baseline estimate that Pilar cited is you're going to lose about $400 billion just from the staffing reductions. But it's really hard to produce this estimate because a lot of what is embedded in it is like the IRS will do fewer audits as a result of not fewer audits of high earners as a result of not having these resources. But it's also, as a result of that, going to impact taxpayer behavior pretty significantly. Because the kind of logic is like if you have like a traffic cop on the beat or you have a speed camera, people are more careful. And that turns out to be true in the space of tax. So it turns out that if people see their neighbors being audited or a corporation that uses a particular tax preparer watches another corporation get audited, they make changes in the behavior with respect to that individual or that particular firm that are very significant with respect to improving taxpayer compliance, which means that as you do less enforcement, you lose not just direct dollars, but also these indirect or these deterrent dollars. And what we conclude is like we think the number could be like 400 billion, but it could also be as high as 2.4 trillion dollars of losses over this decade. And that's because like it is actually hard for us to understand how to think of these behavioral effects when you're going from the IRS of today to an IRS that's potentially 50% smaller, like overnight. Because that is a very different kind of shift than what the agency has historically experienced, where it's grown a little or shrunk a little over the course of like a decade. This is like an instantaneous, very abrupt drop off in its capacities. And there's some evidence, at least coming from the IRS presently in this filing season, that's been publicly reported by outlets like the Washington Post, which suggests that taxpayer compliance is actually already going down. So we're already seeing fewer dollars paid into the agency as a result of people having the view, and there's some online chatter about this as well, that like the IRS isn't going to have the capacity to do much enforcement, so like don't bother paying taxes on X, Y, and Z type of income. The one other piece, I know I'm low on time, so just the one other piece I want to emphasize and super happy to engage with some questions is there's something else that's happening at the IRS that feels really important and certainly important to your communities, which has to do with taxpayer privacy and the use of taxpayer data. And for the sort of very recent and prominent example of this has to do with data sharing agreements that the IRS has entered into with ICE, which led the IRS's third commissioner of this filing season, something that hasn't happened. They haven't gone through commissioners this quickly in a filing season since 1953. The third commissioner at the IRS to decide to resign and sort of because of these actions. But historically, what the IRS has telegraphed to undocumented communities is that you should fulfill your tax liabilities, you should fulfill your obligations, and you should feel safe to do that because your data is going to be used within the IRS by a very narrow sliver of people for the purpose of tax administration. So it is not going to be widely shared. It's not going to be deployed by law enforcement. It's not going to be used for the purposes of immigration proceedings. They were like very explicit with these communities that that was the case. And as a result, this population was paying into the IRS in a combination of income taxes and payroll taxes about $66 billion annually. As a result of like this like agreement which has no precedent and is obviously broken the trust of these communities because like you telegraph something for like the entire existence of this type of relationship and all of a sudden you kind of instantaneously overnight decide the policy is totally different. What we suspect will happen is that people will be more reluctant to engage with the tax administrator. And their reluctance will have two dimensions. One, they might file income taxes less. And the other piece is they might try to with their employers or find employers who allow them to be in work arrangements where withholding isn't occurring. And so we again, it's incredibly hard to guesstimate how much taxpayer behavior will adjust as a result of these types of changes. But we suggest that we think there's a range, but we think that a good way to think about the possible consequence is we're going to lose about $26 billion in tax revenue this year. So over the course of a decade, that number becomes a little bit over $300 billion in losses. And again, this is a really important piece, but it is one piece of a broader concern that I have, and I know many of you have, and many of my co-panelists have, about the nature of data privacy within the agency right now, because you're also seeing data sharing with political actors of confidential tax data. You're seeing data sharing across the government. You're seeing hackathons where like sort of private sector enterprises are being involved in touching people's tax information and tax data in ways that I worry is going to make people nervous and kind of like tax skeptical in ways that I think is going to translate into more non-compliance in the future. But again, I hope the administration reverses course, but I also worry that some of the damage here has been done with respect to the breaches of trust that I think are going to stay with us for a long time to come.
Thank you, Dr. Sarin. The stated objective of DOGE is to save money. And you said that you expect that the Treasury will miss out in about $700 billion. I don't know how much they're going to save. What is the impact of that in the government? What is the actual? How do we see the impact of that?
Totally. So there is a deep irony that you're pointing out, which is that DOGE has been very focused on, under the umbrella of like fiscal responsibility, has been very focused on trying to decrease deficits and put us on a more sustainable trajectory. And ironically, been perhaps intentionally with full understanding, and I don't want to ascribe intent, but like perhaps not so. They're in a situation where just this one set of actions with respect to the IRS, which are hugely consequential, right? Because the IRS is generating 97% of the revenue for the government. So it's like a big deal. But just with respect to what they've done at the IRS, they have lost, we estimate, like an order of magnitude more than what they could hope to gain through spending cuts and workforce reductions that they're encouraging across the government. So I don't want to be like melodramatic or hyperbolic, but I think it's important to like kind of grapple with the reality that DOGE as an enterprise was engaged with a question of, or is engaged with the question of moving us to a more fiscally sustainable path, when everything they've done so far is moving us to a less fiscally sustainable path. And why it matters is not just because we're going to collect fewer taxes and that's bad. That certainly is bad. And deficits are going to be larger. Yeah. But the challenge is that we are going to have to figure out, even if the government doesn't want to be more generous with respect, I think they should do a lot more. You know, we should have an expanded child tax credit that lifts millions of kids out of poverty. Like, I really want to see that, and that costs money. Like, we should invest more in our climate transition, stuff I would like the government to do. But even if we don't do any of that, like baseline level, we're in a situation where our population is aging, our defense spending needs are significant, and we are going to have to find ways to deal with the fact that the Social Security Trust Fund and the Medicaid Trust Fund are extinguishing over the course of the next decade. So, like, we need revenue. And I don't entirely know what the strategy is if you're in a place where the tax system is being able to produce even less revenue to meet current needs, and the needs are growing over time. Like, something kind of has to give. And I think that is a bit why I am incredibly nervous, not just about this moment, but as soon as we finish tax filing season, we're going to be having conversations about the potential deficit financed extension of $5 trillion of tax cuts. So, like, where do you find the bandwidth and fiscal capacity to support that as well is a question I think policymakers should really, really grapple with.
Quickly, I want my colleague Sunita to ask her question before we move on to this following speaker. Sunita, are you there?
I think I see her question, so I
Yes,
can
the
answer
question.
it.
What are some of the top methods the wealthy use to underreport, shelter their income?
So it really differs depending on like what type of, and I do a fair bit of, just because it's easy, I talk about like the top taxpayer and middle income or lower income people who earn salary income. But it's almost, which is like representatively true, but it's almost easier to talk about different types of taxpayers because who earn income in different ways, because the types of evasion or non-compliance you're seeing are dramatically different depending on the type of taxpayer you're talking about. So in some cases, you're talking about people who are proprietorship owners, who, and many of you are working in businesses where they're being paid significantly in cash. And there are a lot of reasons why people decide to be in cash businesses. One of the reasons I'm also interested in academically has to do with processing fees that are associated with credit card and debit card instruments. But it's in part about being able to have the capacity to decide what type of income you're actually reporting to the IRS, because there isn't the same kind of electronic or digital trail as there is for other types of earnings. But even within proprietorships, you have a lot of small business owners who are fully compliant with their tax obligations or who want to be fully compliant with their tax obligations. But the issues have to do with issues of confusion or lack of clarity. I mean, the tax code is a very complicated object where what types of expenses can be deducted and what types of credits people are entitled to is not something that is like super clear, even to those of us who are in the tax community and are tax experts, allegedly. And so the reason why I say that is because part of what has been frustrating to watch this filing season already is the IRS has decided to close 100 of its taxpayer assistance centers across the country. And those are places where ideally and historically, people and business owners have been able to, in person, find someone to provide tax assistance. And that individual can be in a situation where they can get guidance before they ever file with respect to making sure that they're fully paying, making good on their obligations, they're taking advantage of all the credits they're entitled to, they're kind of like good with respect to the tax process. If you talk about people who are so those are like, that's like one category of taxpayer. I think that's important. If you talk about people who are, partnership owners or who have bank accounts abroad where there's a lot of capacity to essentially park income in ways that accrue to you ultimately, but are very not clear to the IRS. And in fact, those structures, these partnerships can be like partnerships bought by other partnerships owned by other partnerships owned by an individual and then owned by another partnership. Where tracing the tree of partnership ownership is an incredibly challenging and daunting exercise. And it's a daunting exercise in a universe in which the IRS has, even now, even at current resource levels, the audit rates that partnerships face are like they round to zero. It's like 0.07%. And so the part of what is happening at the top of the distribution for people who earn income in these like more complicated arrangements is the creation of more and more complicated arrangements, in part as a vehicle to not be transparent with the IRS about where the tax liability ultimately sits. And we know that this is happening with sort of bank accounts abroad as well. And there's been some attempts to try to push towards more data sharing across jurisdictions with tax administrators. But in part, we in the United States have been a source of intransigence, but it's not just us. There's been less of that than you would like to see to make progress on these efforts.
All right. Okay. All right. Well, thank you so much for entertaining that question. We can see how complicated the job of the IRS is. Thank you so much for all the work that you and your colleagues do. I understand that you need to take off for another meeting, but we are lucky to have your colleague at the Budget Lab, Richard Prince Insano, stay with us until the end to answer questions. Thank you so much, Natasha. We appreciate you. All right. And we move on to another guest, Michael Kercher, Deputy Director at the New York University Tax Law Center. Mr. Kercher is going to cover the impact of these moves to cut the IRS and how they relate to the expected moves to extend the 2017 tax cuts. Please go ahead, Mike.
Yeah, thank you so much for having me here today. So, a little bit of level setting on where we are in the process. And what kind of timing might look like. So back in 2017, uh, the first Trump administration passed a very large tax cut. And they kind of separated that huge tax cut into two buckets. The whole thing was around $3.5 trillion. And it was a mix of corporate tax cuts and tax cuts for individuals. So they significantly cut corporate taxes, including by reducing the corporate tax rate from 35% to 21%. So that's a huge difference. Um, on the individual side, they provided tax cuts through the end of this year, 2025. And the thinking there was you never really know if you're Congress, if you can do more corporate tax cuts in the future, but you're very certain that you're always going to be able to like avoid kind of an increase of taxes on individuals when those tax cuts were going to expire. So that was kind of the strategy. And now we've run into that wall at the end of this year. So both the House and the Senate have agreed upon a vehicle, a reconciliation vehicle that kind of sets the basic rules for what this bill will start to look like. So we don't know what exactly the policies will be yet, but we're starting to get a sense of like how much it'll cost. And you can divine from statements of members and the rest what the basic contours are. So they've set themselves up to be able to basically do another tax cut, this time of about $5 trillion. And the timing of that tax cut is a little bit unclear. Congress traditionally responds best to hard deadlines. So you might think, well, these tax cuts expire in December. They have until December. Normally, that's a pretty decent bet. Right now, there's a little bit of a tricky thing because in addition to the tax cuts, Congress needs to deal with the fact that they are going to run out of space in the debt limit and they must act on that. And they are likely to do it in the same bill where the tax cuts go. The date when we sort of like run through and pass the debt limit is called the X date. The official forecasters don't know when exactly that X date is, but they forecast somewhere in the August or September timeframe. That can move up if, for example, like tax receipts go down for any of the reasons we were talking about earlier, or if spending goes up. So it could be August, September, it could be sooner. So that's all to say, in the coming weeks and months, if not even faster, you'll start to see a pretty clear view of what this bill looks like. I think there are just like a couple of like really key takeaways about the price. Two is this is just very expensive. I'll say it again. We're talking about $5 trillion or more in tax cuts. And these are not like evenly distributed across like people of different income categories. Like these are heavily tilted towards the rich. About half are expected to go to the top 5% of earners. We don't know exactly what it'll look like again because we only have a reconciliation resolution. We don't have the bill, but that's kind of the expectation is based on statements made. About half is likely to go to the richest 5%. The second thing is recognizing that this is very, very expensive and some of the like budgetary pressures that Natasha was discussing are real. They're kind of leaning on right now like a magic math concept. So normally the way that like the official scorekeepers of these bills think about scoring, they say, okay, you're going to do a tax cut. How much is that tax cut going to cost as opposed to what current law says it will be? That's how traditionally, historically, you've scored bills like that. And that means that if you want to, like in year one, cut taxes, you pay for that tax cut in year one if you're Congress. And then in year two, if you want to do an extension, a 1 year extension of that tax cut, you pay for it again because of course it has a second year of cost. The way that they're structuring this resolution, they're using what they're calling current policy baseline. And basically, that's saying, well, because we already had these tax cuts, we're just going to assume that they're permanent, and that we don't pay for extensions of tax policy. And so that is a way to basically make more than $3 trillion of that 5 trillion just disappear. There's no policy or substance to it. It's pure marketing. and it is unprecedented. So that I think has a huge set of different impacts, including enormous deficit increases, of course, which are harmful for a ton of reasons. Um, if there is if there are offsets in the plan to help offset some of the costs, the ones that are being contemplated, especially in the House, are really harmful to low-income communities. So they're talking about maybe doing a trillion and a half of some kind of cost cuts. 880 million or 880 billion of that, you can tell kind of what they're thinking because it's in a committee whose big bucket of money that you could raise $880 billion from is Medicaid. So it's pretty clear that there is a very strong move in the House to significantly cut in Medicaid, which would have a tremendously harmful impact on low-income communities, seniors, and others. And then the second bucket of very significant tax cut or of spending cuts that they are thinking about are through SNAP. So you're paying for these incredibly generous tax cuts that heavily tilt towards the rich. If you're paying for them at all, a lot of the pay-fors are coming right out of the pockets of the lowest income people. So even if you give them a very small tax cut, that is going to be far overwhelmed likely by the fact that they've lost their Medicaid coverage, their SNAP benefits, et cetera. Now, as sort of the marketing goes, some policymakers are making the point that you have to consider the policies of this administration more holistically. So don't just look at the bill, look to the other things we're doing, look to the tariff revenue and look to the savings from DOGE. So the tariffs are an interesting one because if you have tariffs, they certainly do bring in revenue, and that is a source of revenue. But I think there are at least two things to keep in mind here. I'm not a trade person, but there are some obvious things. Thing one is the sort of the amount of revenue you would get from tariffs is tremendously uncertain given the uncertainty of tariffs and other problems. So that's probably pretty obvious. And then the other thing to keep in mind is tariffs are taxes, and they are effectively consumption taxes. And consumption taxes are generally very progressive and have a much higher impact on low-income communities than really rich people. And so that's another way in which you're sort of paying for these very big tax cuts for the rich, if at all, on the backs of low and middle income families facing a higher part of the burden of tax. So that's all a shift, right? The whole package, if you take it together, does seem to be moving the tax burden much heavily more towards low and middle income families. And that's an important thing to keep in mind. And then the last part I think here is the impacts of DOGE. And I think Natasha really set this up well, right? The sort of the way it's described is an entity that is there to sort of improve the information technology and the software and programming of the federal government and to ferret out waste, fraud, and abuse. But as Natasha properly noted, one of the biggest impact items here from a revenue perspective and far outweighing anything that you might find in waste, fraud, and abuse are the cuts to the IRS and what that means, right? The Yale Budget Lab has done a great set of analysis on this in terms of what the sort of the costs are. But the key point is there are no amount of waste, fraud, and abuse cuts that waste, fraud, and abuse cuts they're going to find that's going to outweigh that that revenue loss from a defunded IRS and the reduced tax compliance that goes with it. So that's on the revenue side, but then there's also a question of for you and me, what does this mean for our ability to pay our taxes? Honest taxpayers, what's it like for us? So I think a couple of things here. An IRS that is seeing cuts at the level that they're talking about is going to have a really hard time trying to keep the system running well, trying to answer the phones. If you've got a question about how you're supposed to file, you want to call the IRS, it's going to be hard for them to answer the phone in time. That's a problem that you saw really escalate before the big investment in the IRS that we were talking about earlier. Similarly, in the last couple of years, there's been this direct file program that has sort of provided taxpayers with a free way to go onto the IRS website and file without having to pay fees to any of the tax prep software companies. And there's been some pretty strong messaging that might get pulled, which would obviously be harmful to people, right? It's a free and like reliable way to file your taxes today for many, many Americans and other taxpayers. And so I think that's all like taken together, kind of a tough spot to be. I think on the behavioral effects that Natasha was talking about, it's like really useful to think about two things here. One is just like the importance of good information reporting on voluntary compliance. Like I'm an employee of an entity. I get a W-2 from my employee. That's basically all of my income. And so when I file my taxes, it's easy because I know from my employer how much income I have. They withheld on me. They sent it to the IRS already. The IRS knows. Takes me 45 minutes probably to file my taxes, which is really nice. If you don't have income that is subject to that reporting, and that's typically going to be like businesses, large businesses, et cetera, the voluntary tax compliant rate just drops drastically. So for people like me who have uh, income that is like subject to very good third-party information reporting withholding, the voluntary tax compliance rate, 99%, very, very, very high. If you have no information reporting, you drop to a little worse than 50%. So it really turns a system of extraordinarily high compliance to a system of something that looks much closer to optional compliance. And so the IRS's enforcement function is really important to ensure that like the integrity and trust in the system and the trust of people that everyone is paying their fair share and what they owe is absolutely critical. And these cuts that they've done so far have really been aimed at the parts of the service that do just that audit large partnerships, large corporations, really wealthy people. And so that I think is part of the behavioral story that we were talking about earlier. But the key takeaway here, as I said before, enormous tax cut going primarily to the rich, paid for, if at all, on the backs of low and middle income Americans. I would say like that's kind of how I think about it. At the same time, reduced tax compliance, especially from like larger businesses and corporations, and reduced services from the IRS are likely. And then the only last thing I would say is like it's always tricky to talk about non-compliance because most people, most companies, most even very wealthy people do want to and do pay their taxes. And so you can't like paint those groups with a broad brush. But the thing that is unique about them and the reason that it's like helpful to talk about it that way a little bit is because of this information reporting problem. Those are the categories of people who don't have that very strong third-party information reporting and withholding. And so that's why you're more likely to see non-compliance from that segment of the population. So I think that's a good place to stop.
Okay. Thank you, Mike. In the interest of time, I'm just going to go straight to Aravind and just go to questions and ask everyone else, everyone in the call questions that come up in the chat. So Aravind, please go ahead. And as you can see, the topic you're going to talk about is very much the top interest in this call. So please go ahead.
Sounds good. Thank you, Pilar, for having me here. I am structuring my remarks in three parts. One, I believe this data sharing agreement between the IRS and ICE undermines tax revenues and good governance. B, it breaks data privacy firewalls and reduces public trust. And C, it is likely to worsen the well-being of many children and families across the US. So to point A, as Natasha already described, the IRS's job is to collect federal taxes and ensure everyone is complying with tax law. This agreement will effectively reduce how much federal taxes the agency collects because immigrants who are currently filing taxes may be intimidated or worse, deported. Estimates suggest that undocumented immigrants pay over $60 billion each year in federal income and payroll taxes. The nation's fiscal outlook would be worse off because of the administration's immigration actions to intimidate, target, or deport those who are complying with tax law. Also, most immigrants already pay more than their fair share in taxes. Undocumented immigrants, in particular, are ineligible for many government benefits, including Social Security, but they pay federal payroll taxes that help pay for the rest of us to enjoy Social Security. So, overall, undermining good governance. Also, the agreement, as Natasha had already stated, is a distraction from the IRS's primary role, which is to process tax returns, service taxpayers on time, and conduct audits of tax cheats. The agency is already facing mass layoffs, and this is evident in the agency's leadership as they have lost experienced leaders in 3 months. To point B, historically, the IRS has kept taxpayer information highly confidential. Section 6103 of the tax code is pretty clear. Tax returns and related information must remain confidential. It has no stated exception for immigration enforcement. So millions of immigrants, small business owners, essential workers, parents of US citizen children have relied on this and complied with tax rules. Some have even hoped that after paying their taxes on time, this will help someday achieve legal status for them and their families because they're showing good faith. Some of these protections in place were enacted as early as 1976 after the Nixon administration had pursued IRS records to target their opponents. So this is a firewall that has protected everyone in the US from having their tax information used against them. In fact, we don't need to think much further back than 2024. There was wide agreement between Democrats, Republicans, and independents when a contractor who was working at the IRS was found guilty of unauthorized disclosure of many millionaires and billionaires' tax information to the media. So it is surprising when these concerns are not repeated by many policymakers today, including those who have repeatedly warned us all against government overreach and government weaponization. So here is DHS using taxpayer information for non-tax purposes, despite their ongoing legal challenges, including some what they have called administrative errors. On point C, there will be chilling effects for all, not just undocumented immigrants, but also naturalized citizens, permanent residents, those on work visas, and refugees and asylees. Chilling effects broadly refer to when people back away from participation in public life. So immigrant families avoiding healthcare or social services, schools, or other spaces where they perceive risk, even when they have done nothing wrong. The Urban Institute conducted national survey research in December 2024, showing that 29% of adults in all immigrant families and up to 60% in mixed status families, so families where documented and undocumented immigrants are both in the same family, worried about essential activities because they did not want to draw attention to themselves. These estimates are from December 2024, so when the incoming Trump administration's immigration stance was well known, but they were not in office yet. So those numbers are surely higher now. So this is likely to impact how many people file taxes, and also how many people have taxes withheld from their paychecks based on their jobs. This will also mean that a lot of immigrants may not claim certain tax benefits that they have deserved and are eligible for. So what this means is children and families, including US citizens in immigrant families, will miss out on the child tax credit or the earned income tax credit that help them afford basic needs like groceries, childcare, housing, transportation, leaving us all worse off. And I just want to end my remarks by saying some of this feels personal to me. I'm a naturalized citizen now, but back in the first Trump administration, when the public charge rule was expanded, I was on a work visa. I remember feeling so scared about having to ever rely on any type of government benefit or ever coming into contact with any law enforcement because it could jeopardize my legal status in the future. And now that public charge rule expansion is no longer in place, but it's important to remember that none of us are better off when any taxpayer, whatever be their immigration status, are worried about what will happen to them and their families. Oh, Pilar, I think you're muted.
Yes, I'm so sorry. I'm so sorry. I was just saying that many of us feel identified with this situation as well. So many of us are immigrants in the United States and went through situations where we were not entirely yet naturalized citizens. So thank you for sharing that. And I wanted to ask Mr. Richard Priscinsano, he's Director of Policy Analysis at the Budget Lab. The Budget Lab also came out with a report on this issue of the IRS and the undocumented. Does this agree with what Ervin said, and what did you find out?
Yeah, no, I don't disagree with what Rivned was saying. I think there's two avenues. So one is a lot of the individuals that are undocumented are only earning income through a W-2, and so they're having taxes withheld. And then most don't owe taxes at the end of the year. They might get a refund. So currently they might be overpaying taxes because they're afraid to file to get a refund that they might be subject to. So that's sort of one thing. The other piece is that the potential is that those people that are currently now potentially overpaying their taxes might rather have a cash situation with their job. They might renegotiate how they're getting paid so that there's no withholding. So we're getting some money now. I think Natasha said it was about 66 billion. We'd actually might see a drop there because people would stop working in above table jobs. They might try to get paid under the table. I think that's, for me, that's the big issue. The sort of the two things there is that a lot of undocumented pay into the tax system currently. A lot of them, the ones that don't file, most likely are subject to a refund, not paying more taxes. And so you sort of have this double whammy. We're getting more money than we should be getting, and you'd be losing all of that money. And that's sort of, what we found, which I think lines up with what Urban TPC found.
Yeah, and today we see this news that they're also using Social Security's death file, which is where they put dead people or dead taxpayers, to move certain immigrant files to the dead file, supposedly to make people self-report. Do you or Arvin have any comment on this, and what do you think? What do you think this means?
Yeah, no, I'll start first. I'll say I don't have a lot to say on it because it is new. I will say that it seems a misuse of the information. Just to sort of, because the people that they are moving over to the death file could potentially be here legally, right? Like I don't think there was anything about them. It's just that they're claiming that they were terrorists and had criminal records.
Yeah.
I don't know that they're here illegally or have broken any laws. So that makes me nervous to start from. But I was trying to read as we were talking about it because the first I heard it was just before we got on the call. So
yes, that they said that they are moving to the death file people who are tied to terrorism, which they didn't explain or show evidence of, and then they're planning to move other groups of people there. So, what about you, Ervin? What do you think about that?
I think it's important to put this into context of everything else the administration is doing around immigration, because the tax system doesn't exist outside of the rest of the social context. And it seems to me that this is another avenue to push immigrants into the shadows. When you don't have a social security number that's valid, it doesn't just affect employment, right? It affects any credit access to be able to buy a home, to start a business, to even open a bank account. So the repercussions of an action like this, I think, is pushing immigrants further into the shadows, and we're all collectively worse off for it, because the formal economy in which immigrants are able to participate shrinks a little further then, because then you're forcing people who are in the US, including those who are here legally, to participate in the informal economy instead, and forcing them to not have bank accounts, for example, to access basic services. And that's true for ITINs as well, the individual taxpayer identification numbers. In some states, in recent years, undocumented immigrants with ITINs were able to get a state ID, for example, or open a bank account using an ITIN. And now there'll be a lot more fear to do that, or worse off, those ITINs may no longer be valid at all.
Arvind, you mentioned before that this could be chilling, not just for undocumented immigrants, for other immigrants, maybe even naturalized citizens like you and I and many others. Why did you say that?
Sorry, I was playing with the mute button. First point around that, I think it's important to remember none of us live siloed lives where everyone around us has the same identity and status as us, right? So a lot of undocumented immigrants are in families with people who have documented status. We see this most of all with parents who have US citizen children, for example. And when you take actions like these, you push undocumented immigrants to live in fear about being able to access basic services, basic needs, or even tax credits, for example. So undocumented immigrants who have US citizen children can currently claim the child tax credit. They cannot claim the earned income tax credit. Now, when the IRS signs this deal, it would worry me about how many undocumented immigrants with ITINs, for example, may be able to claim the child tax credit because they would live in fear about how that data might be used.
Michael Kircher, do you have any comments? Do you have any thoughts on this?
I shared a series that we've been running on sort of tax information, tax privacy, and the most recent couple of stories have focused a lot on DHS, IRS, and it runs through a ton of different risks. And I would encourage people to just take a look at those. I don't want to spend 10 minutes talking about them right now because of where we are in time. But if people are curious about that, I think those are resources that are hopefully helpful.
Yeah, and the link is there in the chat. Thank you so much for sharing that. Let's see, what do we have here? Is there any polling showing what the public thinks of changes in taxation? Do you know? Anyone? We don't know.
Are you talking specifically around the immigration issue or broadly?
The question is pretty broad.
Okay.
So either or, maybe the cuts to the IRS, the immigration issue. Is there any polling out there that you've seen?
I can quickly flag one thing that I put in the chat on direct file because Michael and Natasha talked about direct file a bit. Urban Institute did some nationally representative survey research. Survey fielded in December 2024 that showed a majority of American adults are interested in preparing their federal taxes using IRS direct file. And we broke this down by demographic groups. It was a majority, it was over 60% among Black taxpayers, white taxpayers, Hispanic or Latino taxpayers. By age, by region of the US, it was a plurality by every demographic group that we saw. And so when Elon Musk and others are talking about the program potentially being on the chopping block, I think it's worth considering that the program is very popular and could be expanded to benefit a lot more Americans.
Yeah, and we've had the IRS many times on briefings talking about this very program and inviting diverse communities to participate. So yeah, we know how important it is. It's Congress. Is anyone in Congress expressing concern about the projected loss of tax returns? Anyone? I throw it out there for anyone to answer.
There's a ton of concern on Congress from some members about the data sharing and the improper data sharing, I would say. There have been some letters coming from both the House and Senate Democrats, pretty broad groups, expressing very deep concern about improper data sharing and asking questions and sort of seeking potentially like audits from GAO, TIGTA, those kinds of inspector general types. On the polling, I dropped in the chat a sort of a resource that will probably do some more polling and research on this exact topic, but I can't speak for them. One thing to note about like 2017, the Tax Cuts and Jobs Act is like right when it passed, it was marketed as a big tax cut and people generally liked it. And it pulled pretty well. Once people realized what exactly was in it and how it really tilted towards large corporations and the wealthy, the polling really dropped. And I think that's a really important thing for this audience to keep in mind because like you might see that same dynamic here. And if people's news sources can kind of explain better early on what's in the bill, then people who are sort of constituents of members can put their piece into their members before they actually vote on the thing.
Thank you. Maybe for Richard, this is a question by Henrietta. Can the use of AI replace some of the IRS agents being let go?
Yeah, there is certainly, I think that's even an argument that DOGE has made. I think there's a couple things that you have to realize about the IRS is one, the computer systems are really quite antiquated. So I was at Treasury for a number of years and left in 2017. And even at that time, there was a lot of the data that was on tapes. And so you had to use Fortran, which for computer nerds is a super old technology. And so the use of AI requires certain capacity in the computing system that I don't think the IRS currently has. And so even if they were to implement it, you'd need the funding from the IRA to update the computer systems to be able to use the AI. And then AI has to be trained. So there is time that needs to be taken, and you need some of those people that they're firing to train the AI to do what they want it to do. But yeah, I think potentially there are things in the IRS, and we sort of mentioned this in our report, that there are probably inefficiencies in the IRS that could be addressed. I think cutting the workforce by 7, 15, or 50% is not the way to do it. But certainly AI could be help. I will also stress sort of um, kind of following up with some of the things about direct file. I think one of the things that people misunderstand about the IRS now is when you get a W-2, if you only have W-2 earnings, your employer files that with the IRS. They file with you, then you send it to the IRS. So the IRS gets that information already. They already have all of the information that you send them. So the time that it takes you to fill out your form for Michael, if it's 45 minutes, that's great. It could be 0 because you just would have to sign a card that says, is this what you earned this year? Yes or no. So direct file, I think, is even a step not quite as far as we could go. So you could really, and AI could help with that, right? Because it's really just taking information from one place to another that's already there, and then sending out postcards to people saying, is this what you earned last year? Yes or no. And if you did, you get a refund of this, and if you not, you can file a return to change it.
Okay, Nicole Chang, do you want to ask your question? And would be the last one. Nicole?
Yes, thank you for the opportunity. Yes, what was the hidden message behind the Trump administration's decision to cut funding for the IRS? Because they might know, they might figure already that if they cut the IRS, they're not gonna get enough taxes collection or everything. So, what is the real message from Trump administration?
I don't know. I don't claim to understand what they're thinking or what they want to express through cutting the IRS. But yeah, I think it's an obvious one. I think most people realize that cutting the IRS is actually going against what they claim they want to do. So I'm not sure how to interpret what they want. I wouldn't want to claim to know what they're thinking.
Yeah, similarly,
Anyone?
I can't divine like intent, but I can sort of listen to what people say. And one thing that I would flag for you is that the president has repeatedly said that he appreciates the time during which we did not have an income tax, where we funded the government through other means like tariffs. And he's also sort of floated creating an external revenue service that would handle tariff revenue. And his selection for commissioner, his nominee for commissioner of the IRS, when he was in Congress, supported a bill that would have abolished the IRS. So I can't divine intent, but if you take all that together, it tells a sort of a story.
I want to quickly loop back to something Natasha had shared about the gap between how much taxes are owed and how much taxes are paid, and how that gap is highest among those with the highest income and highest wealth. And so when there are calls made from people in the administration right now or during the campaign about abolishing the IRS or cutting the IRS resources, it's worth considering that auditing people who have complex tax returns, who have a lot of income sources or a lot of wealth sources that are not easily reported, takes a lot of time. It takes a lot of staff. It's a lot harder to do that than me, for example, just sending me a letter and saying, hey, you did this wrong, report back to us, send us a mail back, right? So when you cut resources for the IRS, you are effectively cutting their capacity and their time to be able to audit people with high incomes and high wealth.
Well, we are at the top of the hour. Actually, we are 1 minute past. So we really appreciate all of you being with us and taking the time to explain all of this complicated issue. And thank you also to all of my colleagues who showed up to ask questions and to cover. Thank you so much and have a good weekend, everyone.